Hello and welcome. I'm Victoria Hartley, Group Editor of Mortgage Solutions and Specialist Lending Solutions. It's really lovely to have you all with us today. We've got a cracking panel for you. So let's get straight to it. Let me introduce you to all three of them. I have Matthew Arena, who is Managing Director of Brilliant Solutions, Matt Tristram, co-founder of Loans Warehouse, and we have Richard Bond, Personal Finance Director at Crystal SF. Fantastic to have you all with us. Lovely. Thank you for finding the time today.
Thank you, Victoria.
Yeah. Very welcome indeed. Now, 2020 lending, it appears down by roughly a third on 2019, but it's in a long climb back. That's what the figures are telling us at the moment. So which areas of the market are offering brokers opportunity right now? And if I can go to you, come to you on that, Matt.
Yes, indeed. So the climb back is well underway, having seen a very significant drop in lending in April and May of last year during the first lockdown. The market has certainly recovered and adapted, and that was demonstrated best probably in November of last year, when the secure loan index showed that lending volume tipped just over 80 million, which is very close back to where we were. I think if you average 100, 110 per month pre-pandemic. The biggest difference is the number of active lenders, with some still paused with some good restrictions. And there are three key lenders who are really pushing the market. Optimum Credit, Oplo and United Trust Bank make up just under 70% of that 80 million that was lent in November. Other lenders like Norton, Equifinance, West One are, have returned to the market. In fact, no, they weren't actually gone, but their lending is increasing slowly. And I think it's more seeing the return of lenders like that and Together pushing their numbers up, which will get us back to where we were before. The lending market, it has recovered, it has adapted. If you remember, November was lockdown too, and we're reporting record figures post-March. So I think lending is on the way. There's obviously some restrictions. If you're not currently working, you're on furlough, we can't lend. But for the people that are working, that have adapted, the market has adapted with you.
Lovely, thanks. Any other thoughts, chaps?
So yeah, I think home improvements and debt consolidation still offer the best opportunities for second charges. I think sort of looking at some stats from rated.com, there's 89% of the millennial age, so that's sort of ranging between 25 and 34-year-olds are looking to undertake some renovations this year. So again, I think sort of loft extensions, anything like that is obviously going to be a big hit for borrowers. I think sort of, although debt consolidation did take a bit of a backseat in 2020, I think it will obviously come back this year. Obviously, we've got the pent-up purchase demand as well that's sort of still there. I think also sort of another good opportunity, a little bit of a different angle is second charge bridging, especially with the stamp duty holiday coming up. Obviously, for buy-to-let portfolio landlords looking to sort of raise some capital for their clients. So certainly, there's definitely going to be opportunities in the second charge market across a number of different products.
Yeah, I don't think it's quite business as usual, and the figures that Matt mentioned there, we're not quite back to the pre-crisis levels, and we don't have as many lenders with as many products in the market as we did. But frankly, the opportunities are very similar. It's no surprise to hear about home improvements. No surprise to hear about debt consolidation. These are where traditionally secured loans have been absolutely fantastic and finding a niche, and you'll see the same. So. And on the criteria perspective, I think you're still looking at things like income stretch, and you're still looking at underwriter flexibility. These are things that put secured loans head and shoulders above remortgages in certain scenarios. So I don't think the fundamentals have changed, and I would say that's a real positive, and general theme from me would be a bit more positivity about what seconds can do.
Lovely, thanks very much, Matt. And can I ask as well, so we've got an illustrious panel of packages with us today. So if you guys could lay out for me why it makes sense to approach a packager on many of these deals, because I don't know, a lot of brokers may often go it alone on these sorts of deals when customers approach. So tell me what you can offer. What's the value?
I think as a packager, as all the guys will probably back up, we play an important role in these type of scenarios. I think we can highlight potential problems with deals, and look at trying to deal with those earlier in the process. We can also look to see the positives in the case as well. So, for instance, ABMs, different sort of criteria, stretches, and whatnot. So, I think this basically means we can provide a more streamlined application process, and ultimately a better customer journey. And I think obviously that ultimately ends in the best outcome for both the broker and the client. And I think having seen a spike in sort of cases for buy-to-let purchases, deposits for buy-to-let purchases, I think we are sort of seeing certain lenders now tightening criteria in that space. So it's definitely something that I think obviously packages with their expertise and knowledge of dealing with these lenders on a daily basis can help sort of drive and support the broker and client along that process.
I would add to that as well. You've got to look at this from the broker's perspective, and I'm glad to hear Rich talking about the best customer journey possible, because from a broker's perspective, they're not going to come across many secured loan applications in a year, not in comparison to the mortgage, the first charge element. And so to do something well, you need to be doing it on a frequent basis. You need to be doing it on a regular basis. So, brokers are experts in their trade, but I think there are few who would consider themselves to be an expert at a second charge case. And that's understandable. So to use an external party like a packager makes complete sense. It's also important to stress that some product access is just not available through the direct channel. The market is not directly comparable, and that's important. And I think that, again, Richard touched upon a point that I want to kind of hammer home here, and that's the criteria flexibility. It's just, if you don't work in this industry day in, day out, you don't know where that is. And the net outcome is a bad customer experience and probably not the best product for the customer. So the process as well, Victoria, for those who aren't used to it, it takes a huge amount of time and effort. It is as far away from a Halifax product transfer as you can imagine, and that has a lot of benefits, has a lot of drawbacks too. So I think the last point I would say is talking to a specialist should give brokers the security that they're doing the right thing for their customer and they're getting that best customer experience, because we're talking about experienced financial advisors here, mortgage advisors, who will really get comfort from the product that the customer is being offered there. So I think that's really important. So I'll just add that to Richard's points, really.
No, that's great, Matt. Thank you very much for that. And this is the thing, at the moment, we've got a very interesting environment for a lot of consumers. This is borne out actually recently. One of the stories from Knowledge Bank, who release statistics every month on their most popular searches, defaults and self-employed with 1 year's accounts have reached the top 5 searches in second charge. So as well as soft footprint and furlough, which all makes sense in the current environment. So is second charge becoming primarily a debt consolidation vehicle? I wonder if that's something, Matthew Arena, can you pick up on that one, please?
Well, I think I've touched upon this with some of my other answers, really. I think that debt consolidation is always a material part of the second charge market. You've got your aspirational borrowing. So there you've got your business interests sometimes, but primarily it's home improvements traditionally. And you've got your needs-based borrowing, which is often debt consolidation, could be a tax bill or something else. So I think that there's no real change. There may be some, and understandably so, a minor shift towards debt consolidation, but you'd expect that with the increase in the tightening of restrictions on unsecured credit and alternative forms of secured credit, so the first charge market. So I think that it's no surprise, Victoria, no surprise at all to me. I think that it's also difficult to quantify the the home improvement side of things. Anecdotally, right, we are seeing a huge amount of inquiries in people looking to buy land on the aspirational side, people looking to do loft conversions and home improvements. And I think that there's a lot of this demand that's been built up over 2020 as people are looking at where they are and how they're living. So I don't think we can just pigeonhole seconds as a debt consolidation product, whilst acknowledging that debt consolidation is rightly a big part of the seconds market.
Thanks very much, Matt. And moving on to the next question, what, if any, innovation have you seen in the sector, and what would you like more of from second charge lenders? If I can turn to Matt Tristram on that.
I think the biggest change in 2020, because lenders have been juggling, they've been having to adapt anyway because the world has had to adapt. The biggest change I think we've seen technology-wise has been led by Nevo, who over the last few years, all brokers have heard of, had contact with, worked with, but they're making strides with lenders like UTB and Optimum and replacing some of the sort of more traditional things. The second charge is a security call, has always been part and parcel of every second charge. Well, Nevo via UTB do like an online check now where you can confirm identification, do online identification checks. So that's definitely made a difference. That's probably technology-wise, that's the biggest change. I wouldn't say 2020 has been a fantastic year for technology change in the second charge market, more utilising what we have already with slow improvements. I think Nevo will be the one to watch.
I would like to say, big thumbs up to the second charge market, because I think that it's not an innovation for 2020, but it was for much of the first charge market, and that's in relation to AVMs. Standard for many years in big chunks of the second charge industry, and yet the first charge market really, I think to be fair to the first charge market, it picked it up quite well. But a lot of that credit can be given to the way that the seconds market has been handling and using that tool for a good number of years. So I think it's always worth highlighting the existing positives within the market.
Absolutely. Thanks, Matthew.
I was just about to say, I think it's encouraging to obviously see that some 100% loan to value products have come back into the market. But I do think it's imperative that we do continue to see sort of the technological sort of enhancements, sort of like Nevo, because obviously we do need to continue to improve the processes. I also think obviously there's been a little bit of a painful experience around obtaining consents during the first lockdown especially. So I definitely think there probably needs to be some innovation looked at in and around that and trying to streamline that process. So
okay, sorry, consents, Richard, would just explain that a little bit.
So the second charge consents, obviously, sort of it still feels it's very much stuck in sort of the 80s and 90s along the sort of the usage of post and faxes. I think there needs to be sort of something along the lines of what Nevo have done, where we need to look at implementing some kind of electronic processes, because obviously at the end of the day, especially with second charge, it's about delivering a streamlined process and also speed and getting the case done as quickly and as positively for the customer as possible. And as I say, I think sort of one big area that can be improved on that is the consents.
Just to add to Richard's comment there about being old-fashioned. So when he's talking about consent, is we need to register a second charge, you need the consent of the first mortgagee, which is on the whole really straightforward but very time-consuming. I kid you not, most lenders tell us they don't have the ability to take an online payment or a transfer. We have to post a check to them. I have literally sat with some of the biggest banks in the country who have said we have no ability to take an online payment. And I mean, that's as recently as a few weeks ago. It's amusing when you sit back for it, but it does delay the process. You've got, the post office is affected. It's slower sending a check. It's the only reason we still have a checkbook, I believe.
It also comes back to why use a packager as well. If you're a broker embarking on this journey, you need to have your eyes wide open with, with all of the various processes, extra forms, it is a totally different kettle of fish, I will say.
Okay, thanks very much, guys. Interesting, and a call to arms for lenders there to pull their fingers out, let's be honest, and get that on the tech agenda of works for the next year or so. Okay, well, turning to regulation, in November, Jonathan Davidson, who is Executive Director for Supervision at the FCA, he flagged the tsunami of credit deferrals that people have taken during the crisis. I mean, we're more than aware of some of the struggles that people are having with debt. And payments, of course, many were offered payment holidays, and deferrals were taken for more than 1.7 million credit cards and personal loans. For businesses as well, the bounce back loan schemes delivered more than 1.2 million loans to businesses, totaling 36.9 billion as well. So again, how can mortgage advisors make sure they're protecting themselves and their customers in such a difficult period and covering themselves completely? Richard Bond, I think you've got some views on this.
Yeah, I think the government, to be fair to them, have generally done a good job during the pandemic. The pandemic of sort of raising cash and putting that into people's pockets. I think likewise, financial institutions deserve some credit as well. Obviously, with the deferral and part payment options that they've given to clients. I think as brokers, we simply have just got to stop close to our clients, understand their circumstances, their needs, and basically be there to guide them through and give them options and of what's available through the banks and other institutions when it comes to repaying the borrowings that they've done. So, I think it's from an advising point of view, it's no different to probably what you do on a daily basis. It's just understanding that possibly your client's circumstances will change and the standard Halifax remortgage might not be the first or only option to them. And that's sort of where people like ourselves, packages, will come into it, because we can look at the scenario as a whole and help assist yourself and the client.
Super. Thanks, Richard. And can I turn to a fairly contentious subject? It's always been levelled at second charge brokers and packages in the industry, but it's a question of fees in the industry, in the second charge sector. So how does the sector need to keep defending these? And if so, how do they? Can I ask what the average fee is now, actually, in the sector for brokers and for packages? Matt?
I would come back to you on that one and say I think it's just a totally false debate that we need to kind of put to bed. The question is not about average fees. The question is about the range of fees. Every product and service has an option. You've got 3 secured loans packages on this call today. There are a lot more out there. And there is such a choice now that brokers have in terms of the structure that these things can be delivered in, and that freedom of choice in a free market should deliver the right outcomes for everybody. It doesn't always, and I'll come on to this in a moment, Victoria. But in terms of not needing to justify it, if you look at the commissions that are payable to intermediaries going direct to lender, so let's use the comparable of the remortgage market, which I think is a fair comparable. If you look at the average advance in remortgage market, it's significantly larger than your average second charge. If you look at your average commission on specialist mortgages, because let's be honest, we've got to compare like with like here, and I think we'd all accept that second charges is a specialist area. You're looking at 0.5% in the remortgage market. If you look at what lenders are paying on average, direct to broker through a club channel. So again, like for like, it's 1.25%. Now, if you factor in the average advances there, Victoria, the broker's earning less on a second charge, right? Now, second charge is a more specialist product. It comes with higher risk, comes with a lot of extra work that we've been speaking about today, all right? So the only way a broker can make that up, if they were to do this themselves, is to charge a fee, okay? If they're already charging a fee, it has to be a higher fee. So the fact that there are higher fees in the second charge market is about there's a need for it. The economics of second charge advice won't work without them. as it stands. So I then come on to, well, they should be higher as well because of the risk as well. We have to factor in the higher compliance risk. So I then look at the actual, so we shouldn't be having the argument. The question is, are people charging too much out there, right? In my opinion, yes, there are businesses that are charging too much, but brokers are free to go wherever they want in the market, and it's the networks blocking that movement, blocking that freedom of choice that really we need to be asking questions of. And I would also say that the awareness needs to change. So, you're free to pay for, as a broker, you're free to use whoever you want in this space. If you're a DA, if you're a DA market broker, and to put some numbers on it, there are fixed fee packaging for 995. It's not just us that offers that. There are others. Other people will offer a percentage of the loan with minimums and maximums. There are all sorts of different business models out there, Victoria. So I do worry about some of the incentives that are out there for people, advising in some of the businesses out there, some of the practices that you hear. So I don't want to say there are no problems out there, but the problems aren't with fees in the second charge market, because if we don't charge the fees, the business model does not stack up. The risk is greater, the work is greater, and per case, we're not earning as much. And to put, again, some of the numbers into context, if you look at I think the average advance in a second charge would need to be 40%, the average remortgage advance for the proc fees to balance out. And when people compare some of the proc fees that I see compared, they're actually packaging procuration fees. Okay, so they're fees paid to the likes of ourselves, Matt's business, Richard's business, which is for an awful lot of work that goes on, again, behind the scenes. That is, you're not comparing like for like, really. So if you're comparing a 3% proc to a 0.5% remortgage, I think you're comparing apples with oranges. So
no, all good points, Matt. Absolutely, and thanks for taking them apart so forensically. I think the issue for me that I've seen in stories that we've run on mortgage and specialist solutions in the past is the opacity of the market to the consumer. Where, as you say, they'll end up being offered a deal where they have no idea that there are other things out there. There are other options, far cheaper options, and that perhaps is where the FCA needs to be looking at how to bust that apart.
And that is not a problem that we see in the mortgage advisor space, because we don't see the mortgage advisor, kind of not doing their work on the first charge front, not looking at the remortgage. That's their bag. I think that these practices can be, they are there, Victoria. Those problems, they do exist. But I think this is where the balance between the demand for a consumer to borrow, the availability of a product to satisfy their demand, and in particular, we're looking at some of the high loan to value products that are in the market at the moment. There's nothing wrong. It's great that these products are available, and we've seen it before, years gone by with credit crunch and demand. It's the advice bit in the middle that's the key. It's the advice bit in the middle that makes sure that the right product gets to the right consumer for the right reasons. And from what we see coming through mortgage intermediaries, we think they're doing a great job of that. But I appreciate that's only one lens on the on the second charge advice space.
Super stuff, Matthew. Thank you very much for that. And I'm afraid that's all we've got time for today. So it just remains for me to thank all of our panelists today, Matthew Arena, Matthew Tristram and Richard Bond. Fantastic from all of you. Thank you very much under strenuous, slightly difficult circumstances sometimes. It's been lovely to have you all with us. Just remains for me to sign off. Say thank you very much for watching.